If you're new to investing, it's easy to get caught up in the hype. Stocks trending on social media, companies everyone swears are about to explode, or businesses that were great 10 years ago but are struggling today. But here's the truth. Some stocks are losing investors a lot of money, and beginners often fall into the trap of buying them. Today, we're breaking down 5 types of stocks you should think twice about before investing, so you can avoid the mistakes most beginners make. This video isn't financial advice, just education to help you invest smarter. Let's jump in. 1. The hype stock with no profits. First, let's talk about hype stocks. These are companies everyone online insists are the next Tesla, but they've never made a profit. A company can have a cool idea, flashy branding, or a passionate CEO, but none of that replaces actual revenue and sustainable earnings. Here's the problem. They rely on fundraising to stay alive. The stock price is usually pumped by influencers or trending hashtags. And when hype fades, the stock crashes hard. If a company has been around for years and still isn't profitable, it's not a growth story. It's a warning sign. Before buying anything, ask yourself, is this business actually making money? If the answer is no, you're not investing, you're gambling. 2. Companies in terminal decline. The second type of stock beginners should avoid is companies in long-term decline. These are businesses being replaced by technology, shifting consumer habits, or stronger competitors. Classic symptoms include shrinking revenue every year, closing stores or cutting employees, getting crushed by newer, more innovative companies, rising debt just to stay afloat. Beginners often buy these because they look cheap. They see a $3 stock and think it's a bargain. But here's the truth. A declining business isn't cheap, it's a value trap. The price is low for a reason. If a company's best days are behind it, your money might be better placed elsewhere. 3. Turnaround stocks that never turn around. Next is a beginner classic, the turnaround story. This is when a company says, we're going to reinvent ourselves, new CEO, new strategy. And investors believe things are about to change. Sometimes it works, but most of the time, the company continues to bleed cash and shareholders get diluted or wiped out. Signs a turnaround probably isn't happening. The company has tried restructuring for years. Revenue keeps falling. They take on more and more debt. The stock price keeps hitting new lows. Turnaround stocks are like toxic relationships. They promise things will change, but they rarely do. If you're a beginner, avoid companies that rely on hope rather than results. 4. Ultra-high dividend stocks with unsustainable payouts. This one surprises a lot of beginners. Stop buying extremely high dividend stocks just because the yield looks attractive. If a stock pays an 8%, 10%, or even 15% dividend, that's not a gift. It's a red flag. Why? Because ultra-high yields often mean the underlying business is struggling. The stock price has crashed. The dividend might be cut soon. Dividend cuts are brutal. You lose income, and the stock price usually tanks even further. A dividend is only good if it's sustainable. If the payout ratio is too high or the company is heavily in debt, that big yield won't last. Don't chase dividends. Chase strong, healthy businesses. 5 stocks you don't understand. This one is simple, but it's probably the most important. Never buy a stock you don't understand. Maybe it's in biotech, AI, cloud computing, crypto-related tech, whatever. If you can't explain in one sentence how the company makes money, you're not ready to invest in it. Because when things go wrong, and they will go wrong occasionally, you won't know whether to hold, sell, or buy more. That leads to emotional decisions, which lead to losses. Legendary investor Peter Lynch put it best: buy what you understand. If you need a 50-page research report just to figure out what the company does, you should probably skip it. So what should beginners buy? If you want to avoid losing money early on, focus on index funds. Large, profitable companies. Businesses with real cash flow. Companies that grow consistently year after year. You don't need to find the next big rocket ship. You just need reliable, steady investments that grow over time. Final takeaway. So to recap, beginners should avoid 1. Hype stocks with no profits. 2. Companies in long-term decline. 3. Failed turnaround stories. 4. Ultra-high unsustainable dividend stocks. 5. Businesses you don't understand. Investing isn't about looking for the most exciting stock. It's about avoiding the traps that cause beginners to lose money. If you found this helpful, hit like, subscribe, and drop a comment telling me which type of stock you regret buying. Thanks for watching, and I'll see you in the next video.